indeed, congratulations to the Grassland team for making today happen, because it's not easy when snow rules out a day. So snow was meant to, we're a week closer to calving, and we have a busy day ahead, so we'll move on if that's okay. Our first speaker is Aine O'Connell, Moore Park Lawrence Shillue. Didn't make it with the change of date, so Aine O'Connell stepped into the breach. So she's had a full week now to prepare for this, so there should be no issues whatsoever. And she's had a few days off as well. So she's well prepped for today. So Aine, as you know, is a national dairy policy executive with the Irish Farmers Association. She was previously policy officer with the Irish ICMSA, and worked also for Arabon Co-op as a dairy advisor. Aine was awarded a PhD in dairy science from Moore Park in conjunction with the University of Wisconsin. She's a native of Tipperary, but now has to put up with living on a dairy farm with her husband up in Mayo. Aine, over to you.
Thanks, Jack, and yes, please bear with me, I returned maternity leave yesterday. So it's my second day back at the job. Anyway, thanks to the Irish Grassland Association for giving me the chance to speak to you today. The title of my presentation is The Foundations for Profitable Dairy Farming. And when we consider what underpins how profitable our farms are, we can look at it in two different ways. Factors that impact profitability within the farm gate and factors outside our farm gates. Within our farm gate, it is worth noting what we have achieved to date. Since 2015, we have grown our milk pool by a third. Going into more detail, we can see that not only has this come from increased cow numbers and land dedicated to dairy, but 50% has come from improved efficiencies on our farms in terms of stocking rate and milk solids. And we can build on these gains when we consider what will continue to drive profit on our farms. Maybe it's too simplistic for me to say, but within the farm gate, I think profitability can be determined by our feeding, breeding and management. And the first part of this is our grass-based system. It is core to our competitive advantage right across the world. A re-evaluation of the cost of feeds undertaken by Teagasc last summer has shown once again that grass is our cheapest feed and will continue to be our cheapest feed. Silage and concentrate are between 3 and 3.5 times more expensive than grass. So we have to maximise the use of grass in our diets. I don't need to tell an audience here today that. But yet the utilisation of grass and the proportion of homegrown feed in the cow's diet has declined in recent years. At national level, we have failed to improve grass utilisation beyond 8 tonne per hectare. We are well off the target set by Teagasc of 12 tonne utilised per hectare and 90% homegrown feed in the diet. We can't seem to break the 8 tonne per hectare ceiling. Is this due to complacency? Have we lost focus? Or is it due to changing weather conditions that have become more challenging? I actually think it's probably a bit of both. And I'm sure John McCabe will expand on that a bit more in his session. Moving on then to Pillar 2. Pillar 2 for me is breeding. Within the past 25 years, the output of our cows has improved dramatically. We've increased output by 30%, going from almost 4,000 litres a cow in 2000 to over 5,000 litres in 2023. Due to a combination of improved management and breeding, we have done this. And this isn't just good for our pocket, but it's also good for our sustainability credentials. Since its introduction, the EBI has shown us time and time again that when we breed for particular traits, the results follow. Focusing on breeding for more fertility in our cows has resulted in shorter calving intervals, as per the slide on the bottom left, and more cows reaching maturity, which indirectly means increased milk solids per cow. And then the last pillar is management. And here I'll focus on the management of input costs. To deliver a maximum input on input costs, or to deliver maximum profit on our farms, we have to scrutinise every cost on our farm and prioritise our spending. This analysis from Mary Kingston of her clients' data shows that each year the comparable costs on the top 10% of farms with regards to profit are between 10 and 20% lower than the median. So the top 10% is the blue line, the lower line. The comparable costs in this analysis includes all fixed and variable costs, costs and an adjustment for unpaid labour. So for example, 2022, tough year, when the differential between the top 10% and the medianist was at its least, the farm with the top 10% with the lowest cost, the top 10% of farmers with the lowest cost, would have returned on a farm with an average with a gross farm income of 250,000, would still have returned 17,500 euro more than the median farmer. And this then can be used to serve as capital expenditure, debt, tax and drawings. The differential in 2023 for the same example, so 250k gross farm income, would be 42,500. So there's ample opportunities if we scrutinise our costs to develop our businesses more, because we have more money then to invest in future opportunities. In our analysis across the 10 years, or 15 years, the top 10% of performers with regards to profit always kept their expenses below 62% of gross farm income. So we can look at this with regards to our own expenses and see whereabouts we are, where we can benchmark ourselves at. And not only do we have to manage costs, but we also have to excel at the technical stuff. And Chagos have given us the blueprint here, outlining the key KPIs for profit and targets we must aim for. The top two, highlighted in red, relate to grass, and we have to increase the amount of grass and grass silage in the diet of our cows and reduce our dependence on concentrate. The other KPI of critical importance is our 6-week calving rate. If we get this on track, a lot of other things fall into place. And within that, I also want to highlight the importance of using sex semen and using CBV to breed quality calves for the beef herd to rear. And lest we forget our responsibilities towards sustainability, Chagos is outlining these targets too. We have to continue to improve our carbon footprint. We need to continue to increase the amount of protein we get off our land, and I'll talk about that a bit later in the presentation. And we need to constantly strive for lower nutrient surpluses in order to protect our waterways. Now, moving on, let's focus on what's happening outside the farm gate and what impacts profitability on this side. And fundamentally, it's a no-brainer, it's milk price. Milk price dictates how much money we can actually make on a farm, or it gives us the that determines our gross farm income. And milk price is underpinned by the simple principles of supply and demand. But policy has the potential to disrupt this balance. On the supply front, it is expected that agricultural production, not just dairy, is expected to contract across Europe in the medium to long term. For 2025 and for Global Milk Outlook, Ornua have predicted that growth in milk supply, in the global milk supply, will be about 0.6%. Traditionally, we would only be concerned if supply growth exceeded 2%, so we're a long way from that. When we look at the main global dairy exporters, and we look across the pond, we can see that the growth in the US is subdued due to a shortage of dairy heifers and challenging weather patterns and feed costs. Their growth expected from the US is only expected to be in the region of 0.35 cents per annum for the next 10 years. So the growth in the US is subdued, and then when we look also at New Zealand, we can see that the landscape there is somewhat similar. We can see that the number of cows is declining and the total effective hectares, so the number of hectares dedicated to dairy, is in decline, where growth has shifted to improving milk solids per cow. Given that the EU, US and New Zealand make up roughly 3/4 of the global dairy export market, these insights would indicate tight supplies in the medium to long term, which should support stronger milk prices. Then focusing on the demand side of the equation. We all know that global population is on track to reach 9.5 billion by 2050, which would indicate ample demand. But more specifically, and what's not talked about, is our demand for animal-derived protein within the same period, which is expected to double. As we all know, protein is an essential macronutrient. But what's special about animal-derived proteins, which is basically milk and meat, is that they are nutrient-dense foods that are a key source for several other micronutrients, such as calcium, vitamin B12 and zinc. With Alice Staunton, a professor in this area, stating that if less than 30% of our calories come from animal-sourced foods, we are much more likely to have micronutrient deficiencies. So we do need to continue to deliver animal-sourced proteins, but there are sustainability concerns to consider when trying to satisfy this demand, particularly land use change and forestry. Many of our critics would question the validity of feeding animals food such as soya and corn that can be directly consumed by humans. The edible protein conversion ratio and the land use ratio aims to address these concerns. When the ratio is less than 1, it indicates that the livestock system creates more human edible protein than it consumes, and this is a good thing. In Ireland, Donna Hennessy in Shogsmore Park has looked at this and has shown that both dairy beef and dairy cows have a ratio well below 1. And this is simply, and we all know it, is underpinned by the fact that we generate meat and milk from pasture, which is typically on marginal land, which wouldn't be suitable for our production in the first place. This means that we can satisfy demand for a critically important nutrient, be it animal-derived proteins and the micronutrients associated with it, in a fundamentally sustainable manner. So there's ample demand, there's steady supply, so we're in a good space. But we have to question, are we satisfying the demand out there adequately? And this is where our processors have a role to play. Our latest milk price analysis, which is for 2023, the 2024 milk price analysis will be out in April time, shows significant differential between the returns of the highest and lowest paying processors. This, in and of itself, is an indirect barometer of co-op performance. Are co-ops producing the optimum basket of goods to return the maximum price to us as farmers and shareholders? If we are to diversify into the premium products and the higher grade products, are they sufficiently lucrative to warrant the investment in infrastructure and upskilling? And in the face of declining milk pool, one has to question how exposed are our co-ops. A lot of farmers have raised to me in the last year the concern of a rising fixed cost in the face of a declining milk pool. I've just done a quick crude estimate, kind of a back of an envelope job, which would suggest that a 10% reduction in milk volume, assuming processing costs of 9.1 cent per litre, which is the most recent or newer estimated cost for processing, will cost the farmer 0.5 cent per litre for in increased fixed costs. For many, this is the same return for existing sustainability schemes. I don't have the answer to these questions, as I don't have the data. I wish I did. But as we scrutinise our own business's costs, we have to hold our processors to the same level of accountability and ensure that they are delivering the maximum price for us. And as I said previously, policy has the potential to disrupt all this. When we break down policy, we can see that we all know the commencement of Trump's presidency has been met with trepidation amongst many industries across the world. Will he encourage domestic growth in agriculture, putting the global export supply out of balance, out of kilter? Will he put in place trade barriers for our butter? We send an awful lot of butter to the US at a high premium. Similarly, the changing government in New Zealand has swung back a little bit. They want to advance their economy by doubling the value of their exports in 10 years. And given how critical their milk exports are to their economy, will they encourage their farmers to expand once again? And at home, we have to look at our domestic and EU policy. And without getting too into this, we all know that the nitrates derogation, and if we lost it in the morning, would be the most potentially threatening policy to impact the livelihood of our farms. TIG has very kindly done this analysis to look at the loss of derogation on the economic success of our industry. And he's estimated that if we were to lose the derogation, we'd reduce cows in the region of 212,000, reduce milk output by 1.2 billion, with a farm income reduction of 235 million and a cumulative economic impact of 1.8 billion litres, or 15% of our total milk pool at present. And per impacted farm, you'd be looking at a loss of about 34 cows, 200,000 litres of milk, or €38,000 in farm income. And particularly on farms of the smaller size, that loss in income would really question the viability of the entire enterprise. 2025 is going to be a big year for nitrates because it's the year we spend planning for the next nitrates action programme from 2026 to 2029. We will spend the year doing 3 consultations with the department, and towards the latter half of that we will look to seek permission to apply for another nitrates derogation. All going well, we'll apply for this permission and we'll get it granted in December. However, more likely, as was the case in the last round, it'll extend to the April meeting, and we might not know whether we have the derogation or not for the next round until next April 2026. But it's not all bad news, because things are changing, and things are changing because of the things we're doing on our farms. The latest EPA analysis of 20 representative sites for river nitrates concentrations showed that the total organic nitrogen load has declined for the first time since 2016, or declined back to 2016 levels, I should say. So this shows that the measures we undertake on our farms is delivering, and we need to continue to build on this momentum. With better results going back to Europe, we can be more confident in securing a derogation for the next cycle and for cycles going forward. And just this on a side note, we have to consider the beef industry. We need a vibrant beef industry for a vibrant dairy industry. And thankfully, beef prices have been very strong towards the back end. And looking at the beef supplies in the country, it looks like there'll be tight supplies for the next year. I'm no expert, but this is what the data shows to me. But in order to harness this and encourage farmers to rear calves from the dairy herd, we have to look at breeding better quality beef from our cows. And we need to start using the CBV and the DBI to do this. And lastly, our demographic is changing. We are now in a period of consolidation as an industry. The milk output has plateaued, and the ages of our farmers is increasing. But our industry is still prosperous. We still can derive a decent living for our families from dairy. And in my opinion, the biggest obstacle to stopping young farmers to going into the sector is the uncertainty with regards to policy. It is very hard to expect a young farmer to invest in concrete and be paid over 7 to 15 years if the goalposts shift every 2 years. We have to, and the department has to give certainty to young farmers in particular, that their investments will be paid off. So to conclude, our breeding and feeding is critical to the amount of profit we make inside the farm gate, but we must also scrutinise our costs and our spends. At the moment, there is steady supply and demand, which leads to a stable, if not positive, outlook on milk price in the short, medium and long term. Nitrates derogation still remains the policy, the most threatening policy to disrupt our livelihoods. And as we enter a period of consolidation within the industry, We have to look at our own businesses and improve efficiencies, and we also need to look at the performance of our co-ops, who have relied on an expanding milk pool to deliver growth in the last number of years, and need to divert their attention into growing in value-add products going forward. I'll leave it at that, Jack.
Brilliant.
Thank you.
Thank you very much.